A lot of movement in the stock market, a lot of volatility. Laura, what are we talking about? What does everybody want to talk about?
Well, Bob, we have a lot of questions about jobs report today.
Jobs.
I know it's a bit of a mixed report. Was it a good report, a bad report?
Laura wants to know. Everybody wants to know. The question today is it a good jobs report or a bad jobs report? The answer is, in my opinion, this was almost a perfect jobs report. So the actual headline number, how many jobs were created, was a little bit below expectations. But they revise these numbers all the time. The other prior 2 months, the numbers were revised upwards. So overall, there's still very, very healthy job growth in the United States. That's good news. How about wage growth? Wage growth on an annual basis was about 2.8%. That's in line with expectations. By the way, that's getting better and better and better. And in my opinion, I want more money in the hands of working people. So I'm happy, more money, good thing. That does stoke a little bit of concerns about inflation getting out of hand, but I don't think it's enough to really worry people too much. If it would have been 3%, I think the market would have been even, the reaction would have been worse. Finally, the unemployment number, the headline unemployment number, the lowest since 1969, that's pretty amazing. So here's what everybody cares about in the stock market. Is this going to change the Federal Reserve's opinion about raising rates, about how quickly they're raising rates? They're going to raise rates again in December, and they're probably going to raise rates 2, maybe 3 times next year. I don't think that dramatically changes opinion. Some people think they'll be a little more aggressive, but I don't think it does. Now, you see today, stock market's down in the middle of the day. What's happened this week is that suddenly interest rates have popped up because the economic data has been pretty good. Stuff that we got earlier in the week was very, very strong. And whenever you get interest rates suddenly move up quickly, that's a big asset class. It kind of upsets the stock market a little bit because they're trying to figure out what do these bond people know that we don't know. They got to know something because maybe they're smarter than we are. I wouldn't worry about it too much. In my opinion, interest rates are going up for all the right reasons. Number one, we have earnings at a record. Third quarter, we're going to see more than 20% earning growth. That's 3 quarters in a row, more than 20%. You know what the normal numbers are? 7%, 8%, good years. We've got the tax cut and we've got a roaring economy. So, number one, earnings are spectacular. Number two, GDP. The country's doing well. We're probably going to do 3% GDP growth this year. We haven't seen that in a long time, more than 10 years. Also, we've got some generally good economic numbers that I think are fueling the whole market. So I'm not that worried about it. I'm not surprised that the stock market's having a little bit of a hiccup this week. But long term, the most important thing, I don't think the Fed's going to be too much more aggressive than they were already in raising rates, and I see no signs of a recession right now. So the two things that kill stock market rallies, I don't mean the Dow's down 200 points. That doesn't matter. It's not statistically significant. The two things that kill rallies long term, over years, Fed suddenly raises rates much more than anyone is expecting because they're worried about something. And number two, a recession. None of those two things, in my opinion, are imminent in any way, and that's why I'm not that concerned about this little hiccup that we're having this week. I know that was a little long-winded. Sorry about that. What's next?
We have a follow-up about the jobs report. Kind of a wonky question. Can you explain the difference between unemployment rate and real unemployment rate?
It's not, what they look for is overall, with the unemployment rate is, a survey. And then they do estimates where they figure out how many people they think really are unemployed. So remember, these unemployed, we say the unemployment rate is 3.9%. These are actually telephone calls. These are statistical samples that are actually being taken. And there is margins of errors on these that are, frankly, very, very large because to get a really perfect number, they'd have to call hundreds of thousands of people to get completely within a tiny parameter. So they have other models that they use to estimate what the real unemployment rate. I wouldn't worry about any of this wonky stuff. The important thing is unemployment is the lowest it's been in decades. The economy is growing. Earnings are still pretty strong. And the probability of a recession is fairly low right now.
That's great. Bob, I know you already touched on interest rates, but do you want to kind of explain what's happening with Treasury yields this week?
Yeah, so Treasury yields, there's a whole spectrum of different Treasury yields that everybody watches. The Federal Reserve only controls short-term interest rates. So when they say, oh, we're raising the federal funds rate, that's basically the rates banks are charging each other. They're looking at now, their targets are about 2.25%. Usually you look at short-term rates like 2-year Treasury yields. what matters for a lot of people is longer-term rates, so 10-year Treasury yields. Most things like, for example, mortgage rates, there's roughly relationships between those longer-term rates and things like mortgages, and that gets very, very important for the overall economy. This week, we've seen a move up in the longer-term rates, the 10-year rate. So the 10-year yield was about 2.08 at the start of the week. Now it's, 2.24? So it's up 16 basis points, or 0.16%. I know that doesn't sound like a lot, but in the world of interest rates, that's a pretty big move. That's unusually large. It's a 7-year high. The 2-year has not gone up nearly as much. So the stock market looks at this and says, wow, that's unusual. What the heck is going on? And we know what's going on. The economy is getting stronger, and the market has come to believe that we need higher rates overall. And you can see what's going on with the wage demands. You saw Amazon's statement they're going to get $15 an hour. Retailers were under some pressure because they're now under pressure. All these other retailers out there, well, what are you going to pay them? We're paying $9 an hour, $10 an hour. Now we're going to have to pay $15? Well, the answer is, yeah, the economy keeps going strong. There's going to be additional pressure. And I think that's wonderful, frankly. I want more people to make more money. So, again, overall, the stock market is a little upset because they saw a sudden rise up in rates. But as I've said, rates are going up for the right reason. When you see an economy like the one we've got, which is historically very unusual, 20% earnings growth, 3% GDP when we haven't had that in 10 years, unemployment at 40, 50-year lows, that's pretty extraordinary. Interest rates should be a little higher because of that.
Thanks, Bob. I know we had some historic news this week. We had a trilateral trade deal with Canada, U.S., and Mexico. Do you want to talk a little bit about the trade war and some updates there and how it might be impacting the economy?
Yeah, the bottom line on the trade war, the Canada, Mexico, and U.S. deal is, frankly, it's not that dramatically different from the old NAFTA deal. I don't want to get into all the political considerations, but it's not dramatically different. And the street, Wall Street, and investors are fine with that because NAFTA has created a gigantic supply chain that's very, very tightly knit. So yes, there are some changes around the edges, but what the market cares about is they're not going to suddenly impose gigantic tariffs. It doesn't look like it, at least on autos. There's a slightly better deal with Mexico. And yes, some parts have to be, a higher percentage of autos have to have parts sourced from the United States. And so you're playing around the edges. The bottom line is there's a deal, and that's what the market wanted, a deal. China's a little more problematic. We don't know. It looks like President Trump is willing to get more aggressive with China. Remember, there are elections coming up. It's easy to use the Chinese as a foil. And I think some of the grievances from the Trump administration about China are legitimate grievances, particularly the theft of intellectual property. So I laud them for pressuring China. But this is not an easy thing to solve. This has been going on for decades. It's not the first one to try to deal with this. President Bush tried to deal with it. President Clinton tried to deal with it. President Obama did, both Bushes. And again, it's very tough to actually move the dial on that. The market is betting that long term, it looks like some kind of accommodation can be reached. Interestingly, if you look at the Chinese stock market, the domestic market, Shanghai market, the Shenzhen market, down dramatically this year. That's because the domestic Chinese market tends to be dominated by very small retail investors, not big institutional players. Institutional players dominate the United States. What that means is small retail players are very susceptible to just frankly getting afraid. They look at it and they say, maybe the Chinese economy is slowing down. Maybe we're going to have a trade war with the United States, and we're afraid. I think I will not have much to do with the stock market. And the participation in the stock market in China is very, very small. I mean, it's probably 5% of households own any stock in China. So all this stuff you hear about China, it's all well and good. Their stock market is developing. We want them to develop. We want trading partners. But don't kid yourself. The stock market's a very, very small part of the Chinese economy. The stock market's a much bigger part of the U.S. economy. That is, people who own stock and trade it or own stock in the United States.
We have a question on Instagram about wrapping up the year on the market. What are you expecting for quarter four? What should we
Oh boy, one of the things you should not avoid doing unless you're a paid professional is don't prognosticate the future of the stock market, number one, and number two, never give investment advice to your relatives. This is a Pisani rule here. Generally, I will violate this and say, I believe that the market's in fabulous shape. All of the numbers are fabulous. However, the stock market is a forward-looking mechanism. In general, traders are trying to figure out where earnings are going to be anywhere from 6 months to a year out from now. And the bottom line is nobody's ever good at that. Nobody's ever good at figuring out what's going on. There have been people waiting for interest rates to rise for 5 years. And finally, it's starting to happen. But if you would have played this game 5 years ago, I'm going to do something that's going to bet interest rates are going to rise in 2003. Loser. 2013, excuse me. Loser. People are terrible at forecasting the future and the stock market. We can't even get the weather forecast right next week. With all that said, generally I am optimistic. Generally I see no signs of recession. I don't see any signs that the Federal Reserve is going to freak out and suddenly start dramatically raising interest rates. And remember, those are the two things that kill stock market rallies long term. I can't tell you if the S&P is going to be higher or lower at the end of the year. Right now, valuations of the S&P 500 for 2019 earnings are not that high. We're about 16.5 times 2019 earnings. If you're wondering what that means, historically, forward estimates for the S&P are in the 16 to 17 range. So you can say, I think the stock market's too high priced, but on a historical basis, it really is not right now, and that's why I'm not too worried about it. Again, I don't know if the market's going to be higher or lower, but I don't see anything that would freak me out right now that say, oh, let's get out of Dodge here and put all our money in a piggy bank somewhere. Last question.
Last question. Story of the week. SEC, Elon Musk, Tesla.
Oh boy, Elon Musk. Okay. I have nothing but love and admiration for Elon Musk. He is one of my heroes. I think when the history books are going to be written, hopefully in the next 50 years, he will prove to be the next Thomas Edison of his day. Nobody else has reinvented the space program. Nobody else has ideas like he has, like completely bust your mind ideas. With that said, his behavior recently regarding his stock has been rather shocking and disappointing. So today he tweeted out, he has a settlement supposedly in front of the SEC. He tweets out a tweet mocking the SEC and then bitterly complaining about short sellers again, acting like he has just discovered that some buy-side firms may lend their stock out to be sold short. He seemed surprised at this. This has been going on since the dawn of the stock market. Short selling has existed since the dawn of the stock market. The very first people shorting stock, in fact, were people who helped invent the stock market. Dutch East India Company was the first big global company. It was around in the early 1600s. It traded in the Amsterdam Exchange. There were people shorting the Dutch East India Company in the early 1600s. That's how long short selling has been going on. There is nothing new under the sun. And yes, people have been borrowing the stock who don't have it and want to short it for a long, long time. In general, short sellers tend to lose. They tend to lose because they're often wrong. The stock market tends to go up over time. And number three, the cost of borrowing that stock and paying it back is an additional price they have to pay. So I'm a little baffled by Mr. Musk's commentary and a little disappointed, frankly. And I hope he just quiets down and gets back to that fabulous space program and that fabulous electric vehicles and the fabulous battery that he's been inventing and has been putting together to store solar power. Just, Mr. Musk, go back to being what you're really good at. That's it for this week. Always a pleasure.